Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended November 8th, 2017. Initially, we'll just cover conventional fund business, but then we'll go ahead and talk about ETFs as well throughout the presentation. We saw about $12.6 billion enter the conventional fund business this week, and this is the fourth week in five that we've actually had positive flows. Now, if we take a look at what's been going on, actually during the beginning of the week we had disappointing non-farm payroll report, 261. I think people expected it in the 350 area, but people kind of shrugged that off, thinking it was just a hangover from the hurricanes again, and expecting better numbers to come out again next month. But when we take a look and look at the markets, we actually saw three separate days this week that just passed where we saw simultaneous record closes for the NASDAQ, the S&P, and the Dow. So it was really a good week. Now, when we're reporting all these, great performance weeks, these are really at the margin. There's not a lot of, big moves. However, we did see, kind of a big move out of Japanese funds this week. They were up about 2.5%. For the week, and of course this is just on news of good earnings, weakening yen, and then also several weeks ago, 2 weeks ago, 2.5 weeks ago, we reported that the coalition government run by Shinzo Abe basically took the major control, or actually maintained their major control over Parliament. And that was supposed to be a boon for stocks as well. So we really have had some good news. Now recently we actually had the House Republicans finally put forward a bill that people can actually look through, digest, and take a look at. Tax Cuts and Jobs Act is what it's called. And that was a big plus as well for investors, because really they've already priced in those numbers. A little disappointment this week. The Senate came out with their plan, and there's a lot of contradictions. We'll have to see if that flies together. Also in the news this week, we saw that President Trump actually put forward a nomination of Jerome Powell to be the next Fed chair when Janet Yellen steps down in February of 2018. So anyways, we saw record closes. Let's see how all this information translated into flows for this week. If we take a look at our macro groups, we see that equity funds lost about $336 million. Again, this is conventional funds only. Take a look at taxable bond funds. They took in about $1.8 billion. And muni bond funds added about $427 million. And the big gainer of assets this week, as people are a little bit hesitant because of these frothy markets, money markets took in about $10.8 billion. So really, it was a good week overall. When we saw outflows out of equity funds, certainly that was a little bit dour, but it wasn't big numbers like we've been seeing. So let's take a look at equity funds in particular, take a look at what happened. Basically, we saw for the week that equity funds were up about 0.33%. The second consecutive week they've seen plus side returns. But again, they were down about $336 million, 33rd consecutive week they've seen outflows. So the trends have been pretty much the same. Domestic equity funds taking it on the chin. They lost about $2.5 billion. And we've seen that for 45 consecutive weeks now that we've seen outflows out of that group. And then if we take a look at the non-domestic equity side, basically we saw that they had a $2.1 billion inflow, a fifth consecutive week they've taken money, and this was on a return of about 0.28%. Now, I told you about the domestic equity funds already. They had a 0.35% return. So investors seem to still be, putting money to work in those international global funds more prolifically than they are with the domestic equity funds. If we take a closer look, we saw large cap funds actually lose about $1.3 billion, while on the, as I was saying, on the international side, international equity funds saw about $2 billion net money come into that group. Let's take a look now at our equity ETF classifications and take a look at what happened there. For 6 consecutive weeks, we saw $5 billion this week flow into the ETF side of the business. At the top of the list, iShares MSCI Japan Fund, again, as I was talking a little bit on the top of this segment, Japanese funds did very well. So the iShares MSCI Japanese Fund, Japan Fund, ETF, took in $550 million, and we saw that the iShares Core S&P 500 took in about $522 million. And then if we take a look at the bottom part of this, people a little bit concerned about the tax cuts, whether they'll benefit small caps. We saw iShares Russell 2000 lose about $670 million. And then we saw the Velocity Shares Daily 3 times long natural gas, ETN, basically lose about $313 million in net outflows. Let's take a look now at the fixed income universe and see how that panned out. Basically, it's the 8th consecutive week they've taken in money, about $1.8 billion. First week in 4, though, they've seen negative returns, this time to the tune of 0.27% return. At the top of the group, we saw balanced funds taking about $808 million. First week in 7, they've actually taken in money. And corporate investment grade debt funds actually took in about $405 million. Now, I would argue that that should actually be considerably higher. In our macro groups that we roll up, which corporate investment grade has about 5 or 6 different classifications from the Lipper side that we roll up to, loan participation funds are in there as well. And loan participation funds had kind of a unique situation this week where the Highland floating rate obligation fund basically had a net redemption. 3 funds liquidated, about $1.1 billion left the coffers of that fund, but it was a share conversion into a closed-end fund, leaving our open-end universe. And so while we did record a $1.1 billion outflow for loan pars, really, again, which rolls back up to corporate investment grade debt, really, we don't think that people should put a lot of validity into that number for the very simple reason that the industry as a whole didn't lose it, but conventional funds did. Now, when we talk about these fund flows, we're always talking about conventional funds and ETFs. Closed-end funds are a separate entity. We consider them outside the realm. They're 1933 Act funds, where the ETFs and mutual funds, conventional mutual funds, are 1940 Act funds. That's the reason we report on this. Basically, it was the 23rd consecutive week, though, that we saw inflows in the corporate investment-grade debt funds. And then if we look at the bottom of the barrel here, we saw corporate high-yield funds lose about $87 million, and corporate high-quality funds lose about $55 million. So not really a big story there. Again, I think most of the story is from the Highland floating rate objective fund. I apologize. I think I called it obligation fund before. But anyways, let's turn our attention now to fixed income ETFs and see how that panned out. Now, usually they're kind of lockstep, ETF investors and open-end investors when it comes to fixed income. But this week, we saw about $234 million in outflows. The second consecutive week we've seen outflows out of the ETF universe on the fixed income side. At the top of the barrel taking in money was the iShare iBox investment grade corporate bond fund. Bond ETF, and it basically took in about $373 million. iShare TIPS bond ETF took in about $205 million. And at the bottom of the barrel, we saw the iShares 20-year plus Treasury bond ETF lose about $897 million. So that brings us now to our muni bond fund universe. And muni bond funds took in about $427 million. It's the third week in 4 they've seen net inflows, but it's the 5th week in 6 that we've actually seen good returns, this time to the tune of about 0.52%. That's a very strong return for muni bond funds for a 1-week period. The high yield muni bond funds took in about half of the net flows. We saw about $209 million under their group. It's third week in 4 that we've actually seen net inflows into that group. Let's turn our attention now to our money market funds group. And money market funds for the 4th week in 5 saw net inflows, basically this time to the tune of $10.8 billion. If we break that down, taxable money market funds took in about $10 billion, and tax-exempt money market funds took in about $766 million. But if we break down the taxable money market funds, we see that on the institutional side, institutional investors were the primary group putting money to work in that group, about $10 billion. And we saw on the retail side about $2 billion in net inflows going into the retail money markets. Well, that is it for me today. Basically, we did hear some interesting news this afternoon. It's not really news, but again, I referenced the Senate bill put forward by the Republican Senate. Basically, it contradicts a little bit of what the House Senate was doing with their tax reform bill. And investors have now become a little concerned about the possible delay of getting this done. That would not be a very good thing for this current administration or the majority led Congress. And so I think investors are a little bit concerned what's going on, so they're putting on the brakes. Not a lot of downside return, but we have seen some kind of ups and downs, more in the red. NASDAQ was up a little bit, Dow was down, S&P was down. And so we're going to keep an eye on that, because really what's been driving this market over the last several weeks is better than expected earnings from the corporations during our Q3 earnings report. So we'll keep a close eye on that. If I haven't done a deep enough dive for you and you'd like to do a further deep dive, you can go to our site at www.lipperusfundflows.com, or you can join us next week when one of our analysts will talk about the flows trends for the week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.